Hi friends! Today we're going to break down one of the most important concepts in trading and crypto, liquidity. It may sound complicated, but in reality, it's very simple if you imagine just a glass of water. This analogy will help explain everything you need to know about liquidity. In finance, liquidity is how quickly and easily you can buy or sell an asset without a significant loss in price. Imagine you go to the market and want to buy apples. If there are plenty of sellers, you immediately get apples at a fair price. That's high liquidity. But if there's only one old lady selling them at triple the price, that's low liquidity. In trading, liquidity is the total pool of buy and sell orders sitting in the order book. Let's explain with analogies first, and then move into some practical examples. On decentralized exchanges with an AMM system, everything depends on liquidity pools. Imagine a swimming pool filled with tokens. The bigger the pool, the easier it is to swap. But if the pool is small, a single big trader can drink half the water in one move. On centralized exchanges like Binance or Bybit, liquidity is usually much stronger because there are lots of traders and market makers. Still, there is one DEX that uses a CLOB system similar to centralized exchanges, and its liquidity can compete directly with CEX platforms. That's Paradex. Now back to the water glass analogy. If the glass is full, you can easily pour in or out small amounts without much change. That's high liquidity. If the glass is almost empty, every drop counts. Pour in or out, and the level changes dramatically. That's low liquidity. The same thing happens on exchanges. A deep order book with many buy and sell orders is like a full glass. A thin book with few orders is like an almost empty glass, where any trade can push the price around. Why does this matter? Let's say you want to buy $1,000 worth of Bitcoin. If liquidity is high, you'll buy it almost exactly at the price you see. If liquidity is low, the price might slip, and instead of $1,000, you only get $950 worth of Bitcoin. This is called slippage. High liquidity means less slippage. Low liquidity means bigger losses. Here's a practical example. Imagine you want to buy $50,000 worth of BNB long. If there's enough liquidity in the order book, your order gets filled right at the expected price. But if you want to short $50,000 worth of BNB and there's only $10,499 worth of liquidity available near the top of the book, the rest of your order will be filled at lower bids. Because you're shorting, that means you end up selling at worse prices and losing money immediately. That's slippage, and it's critical to understand if you trade tokens with low liquidity. Therefore, it is important to adjust the slippage indicator so as not to suffer large losses from price slippage. Now let's compare markets. Bitcoin and Ethereum have massive liquidity. You can trade almost any amount without problems. But smaller altcoins with low volume have poor liquidity. Even small trades can move the price a lot. On major pairs at large exchanges, the order book looks like a full aquarium. On small DEX tokens, it's more like a tiny cup of water. One spoon changes the level. Before trading, always check liquidity. Look at trading volume, the bigger, the better. Check the depth of the order book, how many buy and sell orders are close to the current price. Watch the spread, the difference between bid and ask. A tight spread means good liquidity, but you should also pay attention to slippage. So liquidity is like a glass of water, full or empty. A full glass makes buying and selling easy, while an empty glass makes every move risky. Always check liquidity before investing or trading, because even a promising token can become a trap if there's no liquidity.